your income, of your pension income on your tax return. You don't physically split up your pension income. You just you do it artificially on paper. With the Canada Pension Plan, there is a provision where you can physically split your pension with your partner. That one is called before the fact, but that one you physically are going to put part of your pension onto your spouse's income.
Okay. Oh, perfect.
I know of course there are criteria for everything. It's
exactly.
not
That's why
it's easier said than done.
That's right.
And then there's some eligibility criteria involved, but that's the two options. Okay. And there may be others down the road, but right now that's the two options.
Okay, perfect. Exactly, and that's why we should, we're looking at income splitting or anything complicated, to always sit down with a professional to make sure that we've got everything covered. It's not something you really want to make a mistake in and do it half-heartedly. So we're going to take a break and we'll be right back. We're back from break right now. If you have any questions about income tax tips, we're talking about tax tips and tax strategies to minimize them, you can give us a call at 613-728-1001. And we're back here now with Bruce and Gord. And so we're going to start talking here in terms of retirement income and taxation. So let's talk about annuities. Someone has annuity for retirement, and they're claiming that as income. How is that taxed? What are the tax ramifications on annuities?
It's income.
Yeah.
Okay. So it goes on your tax return as income. Yeah. Now, depending on the type of annuity, you may have tax withheld at source, or you may not. So, of course, if you're not paying tax on it at source, when you file your tax return, you can anticipate having a larger tax bill. Okay. But in terms of the types of annuities out there, I think that's a question for Gord. There's a lot of them out there.
Gord, can you tell us a little bit about annuities? Like what kind of types are available?
Okay. When you are selecting your annuity, the first thing that you're going to want to look at is how that annuity is going to be registered. Okay. I mean, if it is going to be a non-registered annuity, in addition to looking at your income needs, you're also going to want to look at survivorship needs. And all of the things that would go into your good retirement plan / estate plan. Okay. Taking a look if it is non-registered at whether a prescribed annuity might be something that would fit with your investment portfolio is something to look at. One caution that I do have for people on annuities at the moment that they are at historically low paying rates.
Right.
So I think for people who would have traditionally went running into an annuity, that's probably keeping it from coming up as much as it might have in the past.
Right. Yeah, exactly. I mean, the payout is based on a percentage-wise, so interest rates are lower, so you're going to get a payout that's lower than you may be able to sustain your lifestyle. So that that's a good point. Also, we're looking at retirement, so I think generally a lot of questions I get too is about RRSPs and how they work. Can you guys maybe talk about that? So I retired age 65. Hopefully I'm retired. I got a big chunk of my RRSP. Now what?
I guess for retirement income, a big one that's coming up now is the difference between the RRSP and the tax-free savings account. And the tax-free savings account are the newer vehicle. There still is a lot of confusion about them out there. The big one in deciding about whether you're going to put it into an RRSP or a TFSA, I tell people, is to first consider when you might be needing the money. RRSP is still generally the vehicle that's used for longer-term money, with the exception, of course, of Home Buyers Plan, Lifelong Learning Plan. With the RRSP, you are getting a refund on putting the money in, but then there is the taxes payable on withdrawal of the monies. So considering that when deciding, the contract, parlay that with the TFSA, you aren't getting the refund with the money going in, but then you can take the money out of the TFSA tax-free when they need. So which one is better? Depending on your situation, you're going to want to pick and choose. Likely you need both.
Yeah. Another thing too to keep in mind too with RSP is once you hit 71 too, you got to put roll into a RIF.
Correct.
And then you maybe just tell us how a RIF works.
Yeah, and on December 31st of the year you turn 71, you are required to then convert your RRSP into a RIF. Why you would have to do that is it's to keep you from prolonging it in the shelter for too long.
Right. Yeah, okay. And then you basically are just forced to use it all up over the 20 years, right? So.
And it can be converted to a RIF before 71, of course, too.
Okay. Perfect. So we have another caller. We have Karen on the line. Hi, Karen.
Hello.
Hi. Go ahead with your question.
Yes, it's related to what you were just talking about with the RSP.
Okay.
I have GICs, and at age 71, I have to convert it.
Right.
And I want to go into annuities rather than a RIF.
Okay.
What I want to know is are they just transferred over, or do they have to be cashed in, because they wouldn't all mature at the same time?
The first question that would come up is, are your GICs in a sheltered investment or are they in an unregistered account?
No, they're in an RSP,
Okay.
a registered account, yes.
The RIF is not the only alternative for an annuity. There's other types. There's a LIRA. There's others. What they want you to do is they don't want you to have your capital sitting in a sheltered account indefinitely. They want you to amortize it over your expected life expectancy, so that in theory you'll use up the value of your RIF, on or before you pass. Okay. So that as from an estate planning perspective, you're not going to end up with a large chunk of money left over for the estate, because there'll be some estate tax and income tax implications. In terms of the maturity dates, is as your GICs come up for maturity, you can convert them into a series of different annuities, or you can wait and stockpile them like cash in the GIC, but leave it in a sheltered account, and then when they're all matured, you can do one lump sum into your GIC. There's different options, and you'll have to talk to your advisor to see what situation works best for you.
Yeah, I guess I would advise Karen on the same issue, that most institutions will have a daily interest feature, and there probably will be some time, if the goal is to consolidate the entire portfolio in order to make a lump sum purchase of an annuity. But the bank or the insurance company which she has the funds currently held should be able to advise her or set her up with an individual who will help her with her specific situation.
Does that answer your question for you, Karen?
Yes, because I didn't know if, because I'm not doing a RIF. I wanted to go directly into annuities. So it sounds like I can't do that. That I have to wait for them to mature.
Are they held at a bank, Karen?
Yes.
Yeah. Are they redeemable or non-redeemable?
Non-redeemable.
They are non-redeemable, yeah. So if they are non-redeemable, I mean, if you do have a good relationship with your bank, you can always discuss it with them, but there would be some time lag. That is one of the limitations with using the non-redeemable GICs. it's great to lock in to get the higher rate of interest, but there is that limitation then of withdrawal.
Okay, well, thank you very much.
All right.
All right, thank you.
Thanks, Karen.
Okay, bye.
Perfect. So, continuing with income, I guess. So, one of the other things is what other kind of sources of income do people get when you're retired? You know, everyone's familiar with CPP, OAS.
Foreign pensions.
Yeah.
We sometimes see people with British or Australian pensions, one of the things that you have to look for is with foreign pension income, you got to look at tax treaties because some of them are treated differently. Some of them are taxable, some of them are not. Old age pension is another one at 65. If you're eligible for the OAS, you can get it. If you have a very modest income, you might also qualify for the GIC, which is the GIS, we call it, the Guaranteed Income Supplement, which helps top up your old age pension. One of the things we see that, and Gord can speak to this a little bit about, sometimes when we're doing a tax return, we'll look at a tax situation, we'll kind of roll our eyes back a little bit and say, oh my God, who did your investments?
Hopefully not me.
For example, depending on the person's situation, if for example, with old age pension, if your income threshold gets too high, you start paying it back as a tax. So one of the things that we see oftentimes with people who have, say, a lot of GICs or interest-bearing or dividend-bearing income investments is it artificially bumps up their income because they don't necessarily collect the money. Sometimes it gets rolled over into the GICs or to the investments. So they're reporting income, which is the accrued income, but they're not physically getting the money in their hands, and then what they end up doing is paying back their old age pension. So when we see situations like that, we usually recommend they go and see an advisor and say, you need to look at your investments a little bit differently, maybe structure them as capital investments so that you, with a capital investment, either mutual funds or equities, you don't pay tax on it until you physically redeem it. So it can continue to grow for you, and if you need the capital, you can take it out at any time, and you can live on your old age pension and not pay it back. So little tricks like that.
Yeah, it's important to know that, taxes can have a real significant effect on your income if you're not aware of how to really properly structure your investments. So it's
and that's something you always have to sit down with your advisor and look at your situation holistically.
And if someone has done a good job in preparing for retirement, they are going to have multiple sources of income. So the idea that it's going to be a simple one payment coming from one location, I mean, hopefully that's not the case. So hopefully there's money coming in from more than one place.
From the Ontario Lottery Corporation.
And even with that, with those multiple sources, considering, taking a little bit more from one vehicle, one pool of money, which may be registered in a certain way, versus another, will be very advantageous. One of the big things that I see coming up, especially with non-registered accounts, is sequence of returns. That there can be periods just based on the cycles we go through with investments where what you would have planned to do normally may not be advisable for a select period of time.
Right. Yeah, and I think that's an important fact too, is when you have multiple sources of income, is to which one do you draw your income from and at what time. I mean, that's an important important thing to consider too, just to maintain your assets for as long as possible and to really increase that. So let's talk about pension splitting again.
In terms of the so if you have you and your spouse have pension income, and there are different types that are eligible, you can actually file an election with CRA, which is 1032 if I'm not mistaken, which is you can allocate a portion of your pension to your spouse, and typically the higher income earner will allocate it to the lower income earner in an attempt to sort of balance your pension. And we do a thing what is called the optimization, so that because it won't, transferring the maximum that you can doesn't always benefit you it doesn't always give you the maximum benefit. So there's a point in the curve where, if I put too much in, it's not helping. So we do a calculation called an optimization where we find just the right amount, and we can actually do it right to the penny.
Really?
Yeah.
That's good. Perfect. So I think that is it for now. So we will be taking a break, and we'll be right back to talk more about income taxes and what we can do to minimize them. I'm back. All right, perfect. Thanks for joining us, and we're back here. We're talking about income taxes and what we can do to minimize them. Joining me tonight is Bruce and Gord. If you do have a question, you can give us a call at 613-728-1001. And right now we have, I believe it's Mike on the line.
Yes, hello.
Hi, Mike. What's your question?
I